Stock market myths. The stock market. To some people, it feels like this magical machine where you press a button and your money doubles overnight. To others, it's a scary casino where fortunes vanish in seconds. But here's the truth. The stock market is neither magic nor chaos. It's a system full of rules, numbers, and human psychology. And yet, even in 2025, beginners are still walking into this world carrying around myths, half-truths, rumors, and outright lies they picked up from TikTok finance bros, their uncle who lost everything in 2008, or that one coworker who swears they almost bought Bitcoin at $10. So let's clear the fog. In this video, we're breaking down the biggest stock market myths that beginners still believe today. By the end, you'll see the market for what it actually is, not what the myths make it out to be. Myth 1. The stock market is just gambling. This one never dies. People look at the flashing numbers, the green and red charts, and think, yep, this is just Vegas with extra steps. Here's the thing. Gambling is when the odds are stacked against you from the start. You pull a slot machine, and mathematically, you're almost guaranteed to lose over time. The casino always wins. That's literally the business model. The stock market isn't the same. When you buy a share of Apple or Microsoft, you're not pulling a slot machine. You're buying part ownership of a company that sells real products to real people. As that company grows, earns revenue, and expands, your little slice of ownership grows with it. That's not a bet. That's business. Now, yes, there's risk. If you day trade penny stocks or YOLO your savings into the next meme stock, then yeah, it feels like a slot machine. But long-term investing in strong companies or diversified funds, that's not gambling. That's participating in the growth of the global economy. Think of it this way. If you buy a lottery ticket every week for 30 years, odds are you'll end up broke. If you invest in the stock market every week for 30 years, odds are you'll end up wealthy. That's the difference. Myth 2. You need a lot of money to start investing. This one keeps more people stuck on the sidelines than almost any other myth. For decades, the image of an investor was a guy in a suit on Wall Street, smoking a cigar, waving papers around, shouting at screens. If you didn't have millions in the bank, you weren't in the club. But 2025 is not the 1980s. You don't need a broker in a corner office to invest. You need a phone, an internet connection, and maybe $5. Seriously. Most modern trading apps and platforms let you buy fractional shares. That means you don't have to drop $3,000 to buy a single share of Amazon. You can invest $10, $20, whatever you have, and still own a piece of the company. The real secret isn't starting with a lot. It's starting early and consistent. A beginner who puts in just $50 a month starting at age 20 will almost always retire richer than someone who waits until 40 and invests $500 a month. Why? Compound growth. Time multiplies money in ways dollars alone can't. But beginners get stuck thinking they need to save up before investing, like there's a minimum threshold to enter. That's like saying you'll start working out once you're already fit. It doesn't make sense. You start small, and the small stacks up. So no, you don't need to be rich to invest. But if you don't start because of that belief, you might stay broke forever. Myth 4. You have to be a genius to invest. This one's dangerous because it convinces people they aren't smart enough to even try. They see charts, financial jargon, people yelling about price-to-earnings ratios, Fibonacci retracements, candlestick patterns, and they check out. Here's the truth. You don't need to be a genius. You don't need to understand every technical chart or read 1,000-page balance sheets. Most millionaires who built wealth through the market didn't do it by being stock-picking wizards. They did it by being boring. That's right, boring. They bought index funds, ETFs, or shares in stable companies. They set up automatic contributions, and they let compound growth do the heavy lifting while they went on living their lives. The myth of needing to be a genius comes from two places. First, Hollywood. Movies like The Big Short or Wolf of Wall Street make it seem like the market is some secret world where only masterminds thrive. And two, finance gurus who want to look smarter than you so they can sell you a course. But let's put it simply. The best investors aren't the smartest. They're the most disciplined. Warren Buffett himself has said it. Investing is not about IQ once you're above a certain level. It's about emotional control. Can you keep investing when the market is crashing? Can you avoid panic selling when your portfolio is down 20%? Can you resist chasing hype when your friend brags about making quick money on some meme stock? The truth is, patience beats genius in the stock market. You don't need to outsmart everyone. You just need to outlast them. Myth 5. You can get rich quick. This one traps more beginners than almost anything else. They see headlines like, "Teen makes millions trading options," or "This stock went up 400% in a week," and suddenly think the stock market is a fast track to Lamborghini money. But here's the ugly truth. For every person who gets rich quick, there are thousands who get poor even quicker. Yes, you can make a lot of money fast if you happen to time things perfectly. If you bought Tesla before its huge run or Nvidia before the AI boom, congratulations. But the chances of you catching lightning in a bottle like that over and over again are basically zero.
The stock market isn't designed to make you rich fast. It's designed to make you rich slowly. Think decades, not days. If you treat the market like a lottery ticket, you'll eventually lose. But if you treat it like a slow-growing tree, one you water every month with consistent investments, you'll eventually be sitting under a massive oak of wealth. The problem is, beginners get bored. Waiting years for wealth isn't exciting. Watching your money double overnight is. But exciting doesn't last. Boring does. And here's a fun fact. Most of those overnight millionaires who got rich quick, they usually go broke just as fast because they confuse luck with skill. The real wealthy investors, the ones who stay wealthy, are the ones who played the long game. So no, the stock market is not a slot machine where you hit a jackpot. It's a farm. And farms don't make you rich in a week. They make you rich after years of planting, watering, and waiting. Myth 5. The market is too risky. You'll lose everything. This one is fueled by fear. People remember the horror stories, the Great Depression, the 2008 crash, the pandemic plunge of 2020. They picture the stock market as a giant trapdoor that can open any second and swallow every dollar you've got. And yes, the market can drop, sometimes by a lot. In 2008, the S&P 500 lost more than 50% of its value at the lowest point. That's terrifying if you're watching your account every day. But here's what beginners often miss. The stock market has always recovered. Always. Go back through history. Every crash, every recession, every dip, it eventually bounced back higher than before. The chart of the US stock market over 100 years looks like a staircase that keeps climbing. There are dips, sure, but the long-term trend is up. Why? Because companies don't just vanish. People don't stop buying food, phones, cars, or clothes. Innovation keeps happening. Economies keep expanding, and businesses keep finding ways to grow. The stock market reflects that growth. Here's another fact. The only people who lose everything in the market are the ones who panic sell at the bottom. If you invest in a diversified index fund and hold it for decades, the chance of you losing everything is practically zero. The real risk isn't the market, it's you, your emotions, your fear. So yes, investing carries risk, but doing nothing carries risk too because inflation quietly eats away at your savings every year. The myth that the stock market is too risky keeps people from ever starting, when in reality, not investing is often the riskiest move of all. Myth 6. You need to time the market to win. This one makes beginners freeze up. They think, if I don't buy at the absolute lowest point and sell at the absolute peak, I'll lose. So they wait and wait and wait. They sit on the sidelines, watching the market go up, waiting for the perfect moment to jump in. Here's the harsh truth. Nobody can perfectly time the market. Not you, Not me, not even the so-called experts on TV. Sure, someone will get it right every once in a while, but that's luck, not skill. Over the long run, even professional money managers fail to consistently buy low and sell high. And the reason is simple. The market is efficient most of the time. Prices already reflect what's publicly known. To consistently beat the market, you'd have to know something the world doesn't or take on massive risk. Both are very rare. The truth is, you don't need to beat the market to get rich. You just need to ride it. The average annual return of the US stock market has been around 10% for nearly a century. That's enough to turn regular people into millionaires if they stick with it. But beginners get tricked into thinking they need some secret strategy, some insider knowledge, or the perfect stock picking system. In reality, the winning move for most people is the simple move. Buy broad index funds, stay invested, and let time do its job. So no, you don't have to beat the market. You just have to not lose to yourself. At the end, the stock market isn't some mysterious casino, and it's not reserved for the rich, the genius, or the lucky. It's simply a tool that takes patience, discipline, and time to work in your favor. The myths beginners still believe in 2025, whether it's that investing is gambling, that you need to be rich, or that you can get rich quick, are exactly what keep people from ever starting. And that's the biggest mistake of all. Because here's the truth. The stock market has built more wealth for more ordinary people than almost anything else in history. Not because they were lucky, not because they were geniuses, but because they learned the rules, ignored the myths, and stayed in the game long enough to win.